issuer is a trusted entity. Why would you have to distribute the verification when you already have a trusted central party?
But that's when you have one currency, right? So if you have two national currencies, then it might make sense to do something like what we are attempting to do with IBM Worldwire or some other basket-type systems where you have to have distributed consensus, because inherent to the political arrangement that backs this token is that, right? That you have a negotiated thing between two entities.
Right.
And back to the use cases, we've been looking at retail, like having tokens to buy coffee with in the shops adds a lot of complication, private key management and all of that, and what happens if I lose my keys and things like that. Where we found a lot more utility value, like usefulness, is for corporates. So corporates, when they transact, they're transacting a lot more digital to digital. So I am buying some financial instrument from a bank or from another corporate, and then you can have these atomic transactions where you've got a token representing money issued by a central bank or a commercial bank or whoever. You've got a token representing some other financial instrument, whether that's an investment or whether that's a bond or debt or whatever it is, or derivative. And then you can create single transactions which, I pay for it at the same time as I'm receiving it, which could dramatically lower the headache of the kind of reconciliation and having to track what money's doing what. So that's really, really interesting to the corporates that we speak to at R3.
Central banks should issue retail digital currency.
Well, I guess I can start. And typically, for a central banker, I have to start with a disclaimer. Most of my remarks will be mostly questions, but hopefully with my questions, you get a sense of how to think about the issues. But my views are my alone and not the ones from the central bank, the Bank of Canada. So the way we think at the Bank of Canada is that there's three broad areas of motivation. One is to improve monetary policy transmission and implementation. So that would be one motivation to issue CBDC. Another one would be to improve competitiveness in the market for payments. If the central bank were to issue its own digital currency, could improve the market for payments. Also to improve the efficiency in payment systems. And fourth, there are a variety of other reasons which are not usually in the remit of central banks, but for example, it could be increasing financial participation, financial inclusion. Other motivations could be to combat crime. Those are kind of far from central banks' motivations, but they're still discussed as one of the motivations for issuing CBDC.
Yeah, there.
I think you just hit all of them that I could possibly think of, so I don't have anything to add to his questions. I think each of those points are slightly different, and I think they differ, whether or not they are in the purview of a central bank depends on each individual country too, which I think is sometimes an overlooked point, where a retail CBDC might work for one country and be a terrible idea in another country. This was somewhat raised in the keynote, in the opening remarks yesterday, where it could work, like maybe it doesn't work in the US, maybe it makes no sense, but it might make sense in Kenya.
I think it's interesting that we're walking back the financial inclusion argument. Over the past couple of years, I've heard financial inclusion being one of the main reasons why, or one of the reasons discussed as to why a central bank would want to issue a digital currency, whether it's a cryptographic currency, whether it's whether transactions are signed by private keys, or whether it's a more usual kind of account-based system. But now I'm hearing financial inclusion less and less. Is that because perhaps central banks have realized that by removing cash or replacing cash with a technological solution, we're actually excluding and marginalizing some parts of society, those who either are uncomfortable to use technology or unable to. Is that one of the reasons why?
I guess my sense is that for developed countries, which typically they're well served in their means of payments, the question of financial inclusion is not being kind of top of the list. But there's an aspect which you could fit into financial inclusion, which is resiliency. is occasions in which, say, the network has fallen or there's been an attack, a cyber attack on the big banks. You could call that resilience. And the central bank, if it were to have its own system and its own digital currency, it could provide like a backup system the way cash is today, right?
So a digital backup system to be resilient to a cyber attack.
Right.
It sounds like a contradiction.
No, because...
Isn't physical cash the ultimate disaster recovery tool?
Correct. But I mean, if it were a separate system from the systems of commercial banks, it would be a resilient system. Yeah.
So I think back to the resiliency point, it's important to note that what's the main use case for a digital currency in the first place, right? Digital money. It's for remote payments. So when you transact online, that's typically when you need to make payment, and then cash is unusable in that context at all, right?
Yeah.
So unless you have some form of account, unless you have a credit card or some money that sits somewhere else, there's very little recourse for you to make that transaction. So this isn't just a question of financial inclusion for people who are who have less income or who live in less developed countries. This is really a concrete problem for people, the younger people who live in many of our countries, right? They don't have access to secure ways of paying online. They have to go to their parents or someone else to do that for them. So in the case of a resiliency issue, it might be that some central banks are uncomfortable with all the transactional infrastructure being driven just by market forces that don't take into account necessarily the needs of the public that they serve or are meant to serve. So this could be the fact that if you have a monopoly on all transactions that are online, then you could charge monopolistic rents, right? Versus a central bank that might provide cash today at a subsidized rate, effectively.
Right.
And I think there's another aspect to financial inclusion that can get overlooked, because I think the standard discussion a few years ago in this space was, I'm adding another network through which people can pay. And what we're seeing in other countries where you're seeing this growth of e-money is that that's not necessarily a definite good. So in Sweden, you see the removal of ATMs and cash-based acceptance. In Kenya, you see the growth. So if you are somebody who can't use the mobile systems, in Kenya, it's the same story as it always has been, so you're not excluded. But in Sweden, if the cash ATMs are going away, you're seeing fewer cash, now you're being excluded, and then you're worse off.
So what are the consequences, economic consequences? What's the economic outcome of having the CBDC, and also the technical, or privacy, I should say?
Sure. I think before you talk about the outcomes, I think you have to really talk about defining this thing, right? So what should it have an interest rate associated? If so, who controls it? Clearly, the central bank. But should it be zero all the time, or should it have a positive? Should the lower bound be zero, or could it go negative? Could the central banks reach into your pocket and remove money from your pocket in a way that they can't do with physical cash? Should identity travel with this money? One of the asset tests, and this wasn't me, one of my colleagues came up with this thought experiment. Currently, a child can give money to a homeless beggar in the street with physical cash. Should something like that be the acid test for whether a digital version of cash is successful or not? Could that same scenario happen? So a miner, that means a young person, not a Bitcoin miner. Can a young person who's under 18 and therefore maybe can't open a bank account or whatever, depending on the rules of the country, can they transfer money to someone without an address? Right, because you can with cash, whether that's a good thing or a bad thing. So it's something like that, perhaps the acid test for the design of this thing, and that touches on a lot of things like privacy, financial, personal privacy.
Yeah, I think there's a very understudied or not well understood way of how this retail gets into circulation, right? So retail is consumer based. Do you have it, it's just a glorified essentially payment system? Do you have an account-based system with either the central bank or with private banks? Does this coexist beside physical cash, or do you end physical cash? So the zero lower bound is typically in existence just because you can't, if you try to drive your interest rates, for example, in your savings account in your bank below zero, people can take out their money and keep it in cash by the bedside. But if you stop allowing physical cash to circulate by their side, right, then you don't have the concern about the negative interest rate anymore. People can't evade it anymore. Right? So think about the bank penalizing you if you don't spend your money. That becomes a concern. And what implications does that have for inequality? How do you implement that? How do you think about the welfare effects of that? That's not a trivial matter. And if you do go the CBDC route, that becomes a non-philosophical matter as well.
Yeah, this is where there's a relationship between the motivation, the design, and the implications are intertwined. So it's very hard to separate the motivations from the design, because depending on what you want to achieve, then you would design it in a certain way. As Antony mentioned, is the question about, is it an interest-paying CBDC or not? Well, typically we think interest-paying, but you could also have negative interest rates, right? So, and our research has shown that when you have a CBDC that can pay positive or negative interest rate, you have much more power for implementing monetary policy. So in theory, it should be welfare improving, so better for everyone if the central bank were to issue a CBDC that can pay interest, or positive or negative. But indeed, like, how would the people feel of being taking money out of their pockets?
We need some Bitcoiners on this panel to really kind of spice it up and argue against it.
But there's also the account-based system in terms of privacy, right? Never mind a miner paying somebody. Do I want the government to be able to see the entirety of my financial transactions? Right? That can be good or that can be bad, depending on the government. Right?
And if a government shifts from being a good government to
yes.
a bad government.
Exactly.
So, I mean, there's also the question of implementation, right? If you want to implement a privacy protecting system by design, whether you can truly design that to be resistant to a state-sponsored actor that has infinite resources theoretically to beat that system again, that might be, have been designed by a different branch of that same government. That's debatable, right? Again, you might have the motivation, the right motivation, you might have the right design, but the implementation could fall short. So in reality, this is a complex three-legged problem. Right?
Well, and then you also somehow get into this question of government stability, right? So let's think about Venezuela, and I'm not going to call that a CBDC. I'm just going to sort of say that the thing called the petro exists, and part of the government thinks it's okay, and it exists as a form of payment. Another part completely disavows it, right? So they've got tension within a government even, and what does that mean if that system gets shut off, if the government is overthrown? Right, now you have nothing to show.
But is the design of CBDC going to be planned, like the whole design going to be planned by the central authority, or is it going to be the market driven? Because, I mean, it reflects the zeitgeist of people. People have, they may have they may care privacy too much, so they may not use it at all. Like Korea, for example, we have this thing called coinless society. So we were trying to get rid of coins, but that has nothing to do with the privacy. It has to do with just inefficiency of holding coins, right? So do you think the government or central bank will have a motivation, say like tracking or even surveillance on people's how people use cash, right? Do you think that's currently the central authority's motivation, or will that?
I don't think you'll get a global consensus on that. I think you'll get very different answers based on which governments you're talking about. And we all know the ends of the spectrums, right?
And it reflects the concerns of that government, right? Because there are concerns, legitimate concerns about illegitimate uses of cash, right? For funding terrorism and for money laundering, tax evasion, and so on, right? Depending on your point of view, tax evasion may or may not be a good thing. So again, these things are based on policies and the philosophical bent of the politicians that have been oftentimes elected or chosen or somehow appointed in those particular countries that we're talking about.
Yeah, I mean that's a hard question. It depends on the situation and the political deliberations in a given country. I would this also from a personal point of view. I don't think any serious central bank wants to actually go and track people's activities. That's certainly.
Why though? Like, I mean, there are a lot of benefits about terrorists anti-terrorist.
Because institutions have better ways to doing that at the central
I
bank.
mean, do they care about the human? Like, do they think that privacy is a human right? So is it more like a philosophical reason, or
Jeff, can you separate the central bank and the role of the central bank from the other parts of the government who have different jobs? Because central banks, when you ask a central banker, are you part of the government or are you independent? They're going to say,
independent.
Of course, they're going to say independent.
Sure.
But if you ask different questions, then they'll say.
I won't ask any policy questions.
So, but do separate them in your head, because what central bankers want to do sometimes differs from what other parts of the government want to do, and that's common for a lot of different government departments, right?
Right.
So in some of our research we put out last year, we were describing different schemes which the central bank could approach to issue e-money, so a general term for CBDC. One was the account-based system, in which you need to know a lot about your customers. That might not be too hard, like most countries will have a national registry through passports or driver's license, so this is not too hard. But the question comes is like, does the central bank want to get involved in that and having to take care of clients and have all those relationships? And in that research paper, we have the opinion that, it's not the comparative advantage of a central bank to deal with the public. Right now, we only deal with big institutions, and that would be a really big paradigm shift if the central bank were to get involved with individuals. So then this brings you to a scheme in which there are tokens. There's anonymity, but you could still have a scheme in which there's delegation of tokens, in which the central bank issues kind of a core token, then it gets distributed by other intermediaries, which they could do the function of custodianship, AML, KYC, and then the system will actually look very similar to the system we have today, just with a new form of money.
Right, which then comes back to I think, say, IBM's point of view is that one of the things that could happen in such a delegated system is that the central bank effectively acts as a fungibility provider in taking the coins that are issued by different commercial banks that are responsible for the KYC, AML, and so on, of provisioning wallets for people, and then allowing them to be exchanged one for one. The thing is, they're not exactly the same thing. They're non-fungible in essence, but you are pretending that they are, and the central bank's role might be that, right, as that central provider of fungibility.
Isn't that that's what it does anyway? That's its role today with the real-time interbank payment system.
Exactly, but it does so in a credit-sensitive way sometimes.
Yeah, I guess there's a nuance difference between a delegated scheme in which you have custodianship, in which each token has to be backed. Each token issued by the commercial bank has to be backed by a token issued by the central bank. That's pure custodianship. Another delegated scheme in which there's intermediation, in which you might allow these commercial banks to issue fractional tokens, right? And then in that sense, we're back to the traditional system of interbank payments, yeah.
So just to follow up on another topic you had picked up, which was adoption, right? Bitcoin isn't being used a lot for point of sale at all. And I think people sometimes treat central bank digital currencies as if this is the first time that central banks have thought about issuing an electronic version or non-physical version of money, which isn't true. I guess an old literature talking about e-monies. But the question of adoption is actually a very serious one, which is why would consumers use this? Because Bank of Ecuador tried, in 2015, to issue an e-money, and they had to roll back that experiment because nobody was using it, because the government didn't seem credible either. So I think adoption is something that we don't talk about a lot, but why would consumers want to, or the retail sector want to adopt the CBDCs?
And they assume you build it, they'll come, right? But then
exactly.
the commercial sector is very good at incentivizing people to use their stuff. They're good at shilling their own products.
So why should I use a token-based system as opposed to my credit card?
Right, so if I spend $1 on a central bank system and get nothing, no points, but I put it on a credit card and I get loads of air miles and points and whatever stuff, whether I use it or not, then like people like points. So like, what's the incentive mechanism? How can you beat what's being put out there by by the private sector.
Which then loops back to the beginning when we were discussing accessibility, right? So in the United States or in highly developed economies that have these very robust, interlinked, remote payable financial systems, it might not be a big deal. It might not be feasible or smart to do. But in other countries where that doesn't exist, there might be a market for it.
So I want to talk about stablecoin in perspective of central bank. So I think Bitcoin proposed a very elegant solution. If you think about Bitcoin, it's actually a pseudonymous system. It's not an anonymous system. Actually, you can track it down and find terrorists or drug dealers. The reason why all these drugstores except Bitcoin or Silk Road got shut down is because of that pseudonymous trackable system. Is open ledger, right? So if we care about privacy of individuals, right? But we also have to care about the accountability of the bad act of using that private coins, then can we actually issue a stable coin from the central bank in a way that we issue like JP Morgan coin or USDC? Or
That's what we're talking about. CBDC is a stable coin, unless you mean
yes,
the medium of record is on some public or private blockchain as a token.
Yes, on top of Ethereum or Bitcoin or any public blockchain. Can we actually do that in a pseudonymous?
So I would imagine that putting it on top of a anarchic public chain where you have no control over who's mining it, and you may end up paying mining fees to countries which may be sanctioned, is probably out of the question. So it needs to be some sort of private controlled, permissioned ledger like Corda.
But why is that? Why is that an assumption that that's not possible?
I actually would say that there is a whole continuum. So it's about the delegation, right? Back to Francisco's point that there are multiple models to do this, and it's really up to the risk appetite and the policy preferences of the government in terms of what they do. So it could be that you're looking at a use case for cross-border remittances, then a stable coin that is issued by a central bank or a set of central banks, something like a basket of currencies that are composed again of that master coin that the central bank issues, could be something that is plausibly of high utility, right? And could run on a public exchange. But the same, because with that, the same governance issues arise, right? That you still have, and frankly, intergovernment relations are guided by international law, which are a complex set of treaties and traditions and customs, right? And those could be, we could encode that partly in what a blockchain does. And it doesn't necessarily have to be a private permission one that does that, because these are inherently supranational concerns.
Yeah. But you want to control who can record, who can kind of mine, who can do things, no? Unless no one's going to take the risk to allow someone in a sanctioned country to record a bunch of transactions on.
Well, you might allow someone to record transactions, but it doesn't necessarily mean that the transactions have to be honored in the off-chain world. So I think part of the question here is how far is the influence of that blockchain, right? Ultimately, it's a transactional system for financial balances to be moved around. It's not going to affect the real world unless we allow it to, unless there are legal agreements that bind that in a.
Well, what's the point then? If it's not going to be, if the medium of record isn't going to be the medium of record, why bother?
If it doesn't have to be honored, why would I use it? Yeah.
Exactly. Or are you
but
talking like
today,
lightning?
So that's a question that you can pose to today's banking system too, right? It is a system of record for financial balances, but it doesn't necessarily always have to accord with the legal view of the world. That's why we have courts that come back and say, no, reverse that transaction and so on. There's complex things about reality that we work in, where it's not just a blockchain or a financial system. We have to think about the legal system, about the political system, and all the rest of the stuff that Francisco started us with. Right?
So, I guess if you think about which technology underlying a CBDC we would use, well, again, it depends on what the use case is. Some of you might have heard of the Project Jasper. In that first phase of Project Jasper, we actually tried to implement our large value payment system in the Ethereum network, and we realized, well, this is not very efficient. And then, well, why? Because there's not enough privacy between banks. So we started kind of progressing and understanding that probably a distributed consensus mechanism in a system like this might not make much sense. Why? Well, the issuer is a trusted entity. Why would you have to distribute the verification when you already have a trusted central
But that's
party?
when you have one currency, right? So if you have two national currencies, then it might make sense to do something like what we are attempting to do with IBM Worldwire or some other basket-type systems where you have to have distributed consensus, because inherent to the political arrangement that backs this token is that, right? That you have a negotiated thing between two entities.
Right.
And
So
back to the use cases, we've been looking at retail, like having tokens to buy coffee with in the shops adds a lot of complication, private key management and all of that, and what happens if I lose my keys and things like that. Where we found a lot more utility value, like usefulness, is for corporates. So corporates, when they transact, they're transacting a lot more digital to digital. So I am buying some financial instrument from a bank or from another corporate, and then you can have these atomic transactions where you've got a token representing money issued by a central bank or a commercial bank or whoever. You've got a token representing some other financial instrument, whether that's an investment or whether that's a bond or debt or whatever it is, or derivative. And then you can create single transactions, which I pay for it at the same time as I'm receiving it, which could dramatically lower the headache of the kind of reconciliation and having to track what money's doing what. So that's really, really interesting to the corporates that we speak to at R3.